Hello everybody. Imagine you want to trade on the Dow Jones index and the price suddenly breaks out. But you had seen signals beforehand and make good profits. That's the power of price action, not economic news analysis. In this video, we'll dive deeper into the difference between technical analysis and fundamental analysis, and see how price action makes the market simple and profitable. If you want to learn the key terminology and patterns that can take your trades to a professional level, watch this video carefully. Let's start. Before we dive in, here you'll get one of the most complete price action courses from the ground up. Stay with us as we grow together, and subscribe because your support motivates me to share all my experience. Now, let us turn to the main topic. First, we want to explain the question, what is technical analysis? And we'll also give a brief introduction to the basics of price action. Technical analysis means reading price behavior on the chart. We look at candles, price structure, support and resistance levels, and simple patterns, not complex indicators. In price action, we have three main concepts: trend, trading range, and reversal. Correctly identifying market structure before any entry is the most important task. Next principle, multi-time frame. First look at the higher time frame to identify the main trend, then come down for precise entry timing. For example, start with 1 hour or 4 hour, then use 15 minutes or 5 minutes for entries. Short-term price patterns: breakout followed by a pullback, failed breakouts, pin bars, engulfing, and inside bars as confirmations. More important than the name is how price behaves around the level. Does price break with a strength or fail? Trigger: we enter when the price issues a strong signal on the entry time frame. For example, a confirmation candle after a pullback or a strong trend bar. Every entry must have a clear stop. Quick practical example: Dow Jones. 1 hour time frame shows an uptrend. On 15-minute time frame there is a pullback to support and a rejection pin bar appears. Short-term entry with a stop under the pin bar low and first target at previous resistance. Next, we want to explain what is fundamental analysis and what role does it play in the market. Fundamental analysis works with data and news, interest rates, employment reports, GDP, corporate earnings, and central bank decisions. The fundamental analyst seeks the reason behind the price moves. Fundamentals are vital for long-term investing, but for short-term traders, The problem is that the market usually reacts instantly, and the main opportunity occurs in seconds or minutes. So fundamentals are important as background context. We should know the economic calendar and be aware of major events. But for immediate decision making and entry timing, our core tool is price action and the chart. Now let's explore the practical differences between technical and fundamental analysis and how it shapes your trading decisions. So here's the main difference. Technical means only the chart, only the price. Fundamental means economic data and news. Practical summary. Fundamentals say why. Technical shows how and when. For short-term traders, we're not after the reason. We're after clear chart signals to enter or exit quickly. For example, the Federal Reserve makes a decision. The news affects gold. And at that exact moment, we see a big candle on the gold chart. So you could say, fundamental creates the reason, and technical shows us how the move happens. And why do price action traders prefer technical? Because they say, any important news is instantly reflected in price. Instead of following hundreds of headlines, it's better to focus on what the market is showing us right now. And finally, we want to explain why technical analysis is superior for short-term traders, with reasons, examples, and actionable guidance. Point 1. Speed. When a major report is released, the market reacts in seconds and minutes. By the time you open and analyze the news, the main move may already be done. Point 2. Signals clarity. In price action, signals come from price behavior, confirmed breakouts, healthy pullbacks, rejection candles. Those are better for precise entries and risk control. Point 3. Real risk management. Price action tells you where to place stop and profit targets. For example, stop on the last swing and target at prior structure or risk to reward ratio 1:2. That lets you trade without guesswork. Point 4. Fixed short time frames. Price action behaves more reliably on 1 minute, 5 minute, 15 minutes, and 1 hour time frames than fundamentals, which make more sense for longer holds. Practical example. Gold. Before release, gold was in a tight range. A news spike occurs. A price action trader watches the pre-structure and the pullback after the spike and enters on a clear signal, not by guessing the news outcome. In the end, fundamentals tell you the reason, but for short-term and price action traders, Technical is the more practical and faster tool. Learn the market structure across time frames. Then use the lower time frame for precise entries. Risk management and waiting for a clear signal will be your edge. If this video helped you, like it and comment which asset you want us to focus on: Dow Jones, gold or stocks. And if you want more, subscribe so we can cover more practical price action lessons together.